Greetings, Professor McKee here with the next seminar Saturday, and we're going back to social networks. So this paper today for this week's seminar is called Social Influence in Household Equity Investment, Evidence from Randomized Military Drafts. And preemptive apology, because I'm sure I'm going to mangle at least one person's name here. This is by Chun-Che, Tim Chih-Ching Hung, Ming-Jen, and Kevin Tseng. They presented their paper at AFA in 2025. This is a working paper, not published as of early 2025. And I was at AFA for 2025, so I was at this presentation. I saw this paper, thought it was interesting, especially because they had this randomized selection into these peer groups, and I decided to present it because of that. So this is another paper on social networks with randomly selected groups. We had a previous one that from Kelly Shu a couple weeks ago, but this topic is looking at a very different group of peers. Instead of looking at CEOs or top executives and how they make decisions that at the level of the corporation that they run, we're looking at retail investors, what investment decisions they make. So very different groups of peers. So pretty different in terms of what the outcomes we're looking at, even though both those papers look at social networks. So how do our peers affect our investment? Because we're all retail investors too. So are ordinary people making different financial decisions, household financial decisions, because of their peers? Are those decisions good or bad? There's some obvious relevance here for individuals like us. And on a bigger picture scale, while each individual investor is not going to be able to move the market very much, if we all move together because we're affected by our peers, we might actually move things. We might all pile into GameStop because our peers are talking about it or something like that. Now, there are issues with our peer group, which I've gone over in the Shu paper, and I discussed that a few weeks ago, so you can look at that too. But I'll go over it again. Friendships are chosen, and they're not chosen at random. We choose friendships because we like the person. At least we usually do. And we are similar to people. That makes us more likely to like them. So we don't have randomly assigned peer groups. That makes establishing that the peer group, the social connections, caused my change in behavior versus other things like just we're similar to each other, so we behave in similar ways, not because we are friends, just because we're the kind of person who participates in the stock market or doesn't. There's also the potential for common events that affect us, cause us to become friends, and also cause us to behave in similar ways. So that again makes establishing causality difficult. And finally, we don't really know always in every case if this is an actual personal connection, like we really actually are friends with each other. And if we have a randomly assigned group that forces bonding and friendship and such, then we kind of avoid all these issues because we know they interact. We know that any common events can be controlled for because they're all going to affect the same people. We know that they're actually friends or at least social connections. So the Shu paper used randomly assigned groups at Harvard Business School because there's individual sections within an incoming class, and everyone within that section is taking classes together versus their fellow alumni who are graduating from the Harvard Business School the same year, but they don't take all the same classes together. So there's a very nice randomly assigned groups there. This paper is using a military draft. So Taiwan has a military draft, and all male citizens are drafted into one of the armed forces. The military branch you get assigned to is randomly selected, and your unit within that branch is also randomly selected. So there's a double random selection here for everyone, and it's very broad, at least according to the authors. Several of these authors are from Taiwan, and basically every young male after they graduate college, or if they're not going to college after they graduate high school, is going to be randomly put into some military unit. And so their peers are, of course, going to be the other people who've also been drafted into this military unit. Now, they can get tax returns and therefore wealth information from the Taiwanese government, so they can observe the actual income of these people, including the sources of income. They can observe their wealth, so what sort of investments they have. And then they also have stock price information for publicly traded Taiwanese stocks for the Taiwan stock market. Now, there's some limitations here, so they can't actually see the employer name. There's basically the data they have has been somewhat anonymized because governments tend to not just hand out everyone's tax returns without at least doing putting in some effort to prevent privacy violations. But they can see the income of each person. And it turns out that the wage you get when you've been drafted for that year or two is really low. It's much, much lower than the minimum wage in Taiwan. $200 a month after you convert it to US dollars versus $600. So it's a very clear difference that this person is earning so little money, this person must be in a military unit. So they know that this person is working for the military because of how low the income is for that year. Now they're able to identify 25 peer groups using that income information, and they have 5 years of their data. They end up with a group size of 2,800. So each group has 2,800 people. That's really big. And that's a problem for them because when we're thinking about social interactions, the number of people that really can influence us is not 2,800 people. That's far too large. To be plausible, you would want to have a smaller, closer knit group size. And of course, if you're in the military, you're probably going to be interacting with a smaller group. This is a smaller group that you're living with, you're doing your military training and such with, so you're probably going to be influenced by them if you're going to have a peer group influence, but your group is not going to be at the 2,800 size level. It's not an insurmountable problem for them. They can argue, well, this is just going to make our effects weaker because there's a lot of people in here who are not, or just adding white noise to our numbers. But of course, you don't want white noise because that reduces your ability to find anything, and you'd prefer just to have a smaller group and not have to try and make that argument. So one thing that they exploit is that draft notices do not arrive immediately after the man becomes eligible. They happen in waves throughout the year. And while they can't observe the draft notice, again, because military income is noticeably lower, they can take someone and say, you had an income drop, your income dropped part of the way through the year. So we can get a pretty good estimate of when you started working for the military. And we know it happened. And once you start working, you're not going to stop until the draft term is over. So if you have basically 50% of your income is really low and 50% was not at that military level, we know you got drafted right around June. So they use that estimation, and they're able to expand the number of groups based on military units, and they get an average size now of 750, which is a lot lower. They've substantially reduced it. It's still pretty high, but they've improved that dilution of peer size by quite a bit. So some summary statistics about what their peer groups are looking like. So they have 750 on average. These are, of course, young men. Average age is 22, 23. And they're not very wealthy. They don't have very high income because, of course, they're young men graduating just out of college, and they're not going to have much savings, and they're not earning much money because they're working for the military. And what they do is they test these demographics that they can see based on the tax returns to confirm that all these groups that they are estimating really aren't very different from each other. And if you look at their p-values on things like age, income, wealth, if they have a college degree, if they have a specific kind of college degree, which I will criticize later, and if they're married or not, these p-values are very high, which is what they want to see. So they're not seeing much of a difference here. The only thing that's even remotely close is age, but everything else, there's basically no difference. And the first thing to look at is, do these people start participating more in the stock market during their military service if they have peers that are also buying stocks in the stock market? So this is basically a dummy variable. Did you buy a stock in the stock market at all, which is something that will show up on your tax return, or do you have nothing? It's empty. And what they find is that pre being drafted, people are not participating more. During their military service, and I think they have about 2 years, 2 years afterwards, the probability that they're going to have any stock purchased, so they have some participation in the stock market, at least one stock, is going up. And so they're basically attributing that to, they learn about participating in the stock market from their peers, and they start doing it themselves. Now, why are they doing this additional investing? Are they learning useful information about how to invest and save for retirement from their peers? Probably a good thing then. Or is it a bad thing? Is it peer pressure? Are they trying to fit in with their peers and putting money into the stock market when maybe they really shouldn't be? Maybe they're investing in bad, high risk kind of investments that will lose money, and they would be better off just sticking it under their bunk bed in the barracks, or however Taiwan military houses their draftees. So the authors try and look at some characteristics based on the demographics of their peers. They claim that based on these demographics, this is going to track their peers who participate in the stock market sharing information versus trying to maintain social status among the peer group. So they look at age, higher income, higher education, financial literacy, where they are measuring that based on what kind of college degree the peer has. And say, well, this is information transfer, not peer pressure. Personally, I am not convinced. Many of these characteristics could be tracking information sharing, but I suspect they could be tracking social clout of the peer as well. If you have an older person in your military unit, could that age be correlated with their ability to share information? Yes. It could also be correlated with how much social prestige that peer has. Same thing with wealth, with income. Same thing with if they have a college degree or not. It could be that they're sharing information. In my opinion, it also could be just this person is more socially prestigious, and so you're trying to imitate that person even though they're not really sharing information with you. Now the financial literacy part, where they're looking at the degrees, that makes the most sense to me, but I have a really huge problem here, which is you're including management majors. Management majors in finance and economics. There are two things in here that are very similar, finance and economics. Management is not. I teach management majors in my intro finance class because I'm a professor in a business school. The management majors take one finance class, and then that's all they do, probably. They're not required to take any more. A finance major or an econ major, they're going to take a bunch of finance classes. So I can totally believe that a finance or economics major has more financial literacy, and it seems like they're probably not going to have different social status just because they have a finance or economics degree, at least versus someone with a different college degree. I'm really puzzled by why you would include management, because management is not really finance related. Now, if you had accounting, economics, and finance, well, that's I would follow that along perfectly fine. But you might as well just throw marketing and any other business degree along with finance, economics, and management if you're going to think that management counts as being high financial literacy. I'm really skeptical of that. Another issue here is that they're splitting based on, you have high age versus low age, you have high income versus low income. And for age and income, I am not sure how they split. Like, it could be median, it could be top 20%. Like, they don't say why. They don't say what they're splitting by, and they certainly don't say why they chose that way, because I don't even know what way they did it. Now, education, they do say, well, do you have a college degree or not? And that's pretty normal and pretty straightforward approach, and I have no issues there. They're not telling me how they're splitting based on income and age, and I also don't really buy the management counts as improving financial literacy. So most of this table I don't believe. What they do find is that when they split by age and income and education, and within education by degree, the high age, high income, college degree, and finance, econ, and management peers are associated with higher stock market participations. It's actually negative. If your low income peer owns stock, you participate less. So the coefficient here is quite small compared to the positive coefficient, but they find what they're looking for. I just don't know if I believe that it really shows that it's information versus social prestige and keeping up with peer pressure. And I'm really not convinced that financial literacy is really what we're looking at here. Okay, but they go on and say, what about the investment choices? So this, up until now, we've just looked at, do they buy stocks at all? But what stocks do they buy? Are they perhaps buying the same stocks as their peers, or are they just going out and buying different stocks? Well, individuals are more likely to own the same stocks as their peer group during their military service, a couple of years after their military service. They aren't more likely to own those same stocks before, although it is a positive coefficient here. Well, there's not that many stocks, and probably there's a lot of people herding into the big famous companies, and so that might be why we still see that positive coefficient, even though it's not statistically significant. And again, this is owning any amount of stock in the same company. So you can own 1 share, you can own 1,000 shares. Probably for these guys, because they're not very wealthy, they're young men just out of college, they are probably owning pretty small amounts of these shares. Okay, so individuals participate in the stock market more and they buy the same stock as their peers. They think they're showing that it's information sharing. I'm not convinced. But I'm not the referee for this paper, so maybe they will have a referee that agrees with them. Now, next question they look at is how the investments of these individuals are going to do. Because if you know much about household finance, retail investors are notoriously, horrifically bad at stock picking. They have terrible returns. If they try to stock pick, they always do much worse than if they just bought an index fund and just sat on it for the entire year. It's stock picking is just a terrible idea if you don't know what you're doing, and retail investors pretty much never know what they're doing. Even if you know what you're doing, it's really, really hard. Now, this is tricky because they don't actually have the brokerage accounts of these military young men who've been drafted into the military. All they have is the annual tax returns. So they don't know the timing of when you buy and sell stock. All you know is a single snapshot of what they have every year during when they turn in their taxes. They can see a few things like dividend income or capital gains, at least for certain types of companies. So they try to use that first. So look at dividend. and they look at the dividend income of these individuals pre-military service, during it, and then post afterwards. And during military service, they're seeing a pretty weak, in terms of statistical significance, increase in their dividend income per year. It goes away once they leave the military. Now, they think when you're in the military unit, your peer effects will be the strongest. You might still maintain connections with people that you bonded with while you were suffering through the military draft in the years after, but during the experience, the peer effects should be strongest. Now, does this mean they're earning more money? Maybe, but we don't know if this return from the dividends is actually a higher return than normal than if they just put it into an index fund in the overall Taiwan stock market. So this is a pretty weak increase, and it's a very rough proxy for return, so we wouldn't trust this too much. They also try to look at capital gains. They can't do very much here because publicly traded companies are not taxed by Taiwan. So on the tax returns, no one reports their holdings in publicly traded companies because you don't need to, and so they have no data. Now, private companies, for whatever reason, were taxed, but only for a couple of years in their sample, and then it got shifted into the not being taxed category, just like public companies. So they do try looking at private companies, although again, you might notice our N here is very small. There's not many people with private companies. They're kind of, by definition or construction, rather difficult to invest in. And what they find is that actually they're losing money. They have negative capital gains, particularly during military service. It actually becomes positive capital gains after. But again, a lot of these are pretty weak in terms of statistical significance. And our sample size is really slow. It's dropped a lot just because not many people are going to be buying private companies. Also, they only have a few years of data here too. And then the last approach they try to take is they construct a portfolio of stocks based on this peer holding. So they look at all the stocks, they measure how much peer ownership each stock has. So if the stock has a high peer effect on average, there's a lot of people in the military unit who own this stock, so there'd be a high peer influence. And they look at shorting the stocks with very low peer effects. So there's fewer peers that own this stock. And this is a very standard asset pricing approach. We think we have a trading strategy. Their trading strategy is basically buy the stocks that the peers own and short the stocks the peers don't own. And you sort them into groups. They do terciles, and then you buy the highest buy the highest sort. You short the lowest sort, and then see what your returns are. Now, when you do this kind of thing, you're conventionally going to use quintiles, 5 groups. So group 5, you buy, group 1, you short. I'm not really sure, again, why they pick terciles. They, as far as I can tell, don't say. And again, it's kind of a flag. If I was a reviewer, I'd be like, why'd you pick terciles? Shouldn't you just pick quintiles like pretty much every other paper that does this kind of portfolio construction does? Like, does it not work when you do quintiles then? That would be a concern for me. Now, every year, people do their taxes so they can re-estimate peer effects and they rebalance their portfolios. That's because we only see their holdings once a year. So even if they wanted to rebalance sooner, they can't. And this is not necessarily a bad thing. One critique of this kind of approach is that if you're constantly rebalancing your portfolio, resorting all the stocks, then you're going to be doing a lot of transactions throughout the year. There are costs for the transactions, cost money, cost time. And so if you have to rebalance your portfolio every week in order to do this trade strategy, even if you find positive returns, it might not actually be that a profitable trade because you pay so much to do the trades. And they look at raw returns, they look at returns adjusted for some common risk factors. CAPM, which if you've taken a finance class, you will have seen CAPM. Every one of my students in my intro classes experiences that. There's also the Fama-French three-factor model, which has some additional factors, risk factors that you control for. And the point of that is you're looking at the abnormal returns, the additional returns over and above just the regular stuff you're going to get just by investing in any old stock in the stock market. And surprisingly, they find that the high-low portfolio has a positive abnormal return for the first 3 months. That they found a positive return at all is kind of surprising. Because again, retail investors, the kind of stocks that, especially like a 22-year-old is picking is probably not very well considered. Now it does kind of reverse, so they see a negative return with the strictest part where they're controlling the most for other factors. That's a pretty strong negative result. Note that it's mostly coming because this low category has shot up in terms of high returns versus our high category. And it's still negative, although insignificant now, if you hold it for the entire year. And frankly, it's a little surprising to see any positive abnormal returns, just because retail investors are just so bad, especially if you're young. That's not someone that young. Now, why are they getting these better returns? Is this some sort of fluke, or like what's the channel? Why can they do better? Now, sometimes with returns like this, especially for social networks, and one interpretation is they get better returns because they're using inside information. It's an information channel. And if you're talking about CEOs and members of boards of directors, yeah, insider trading is very much a possibility. But these are 22, 23-year-olds in the military. They're not going to have inside information about public companies. They're probably not sharing information about expertise and how to manage their trading. So the possibility that they decide to test, which is what you kind of are going to go to after you've ruled out some of the easier choices like insider trading, is maybe they're just avoiding the really bad investments. Because there's some really high risk stocks that also tend to be well known and popular, and because they're high risk, they're not actually a good trade. So they look at 3 measures of high risk. They look at beta, which is basically the higher your beta is, the more exposure to systemic risk. So you're higher risk if you have high beta. And the high group, their tercile that's the highest in pure effect, has a lower beta. Okay. And they use something called MAX, which is basically a lottery-like stock. It's from a paper in 2011. I will have a link to that paper if you are interested in looking at how Bali, Cakici, and Whitelaw define it. And again, the lottery-like characteristics, if you're in the high tercile, there's less, you're less likely to have those lottery characteristics. And then idiosyncratic volatility, which is just the volatility of that individual stock. If you're in the high group, again, that's lower. So it seems like these groups of high pure effect stocks are less volatile, less risky than the average stock, which would actually point towards them getting better returns, because these are the kind of high risk, crazy stuff that people tend to blow themselves up if they try to play really high beta, really high volatility kind of investments. Now, again, keep in mind, these were we buy the stuff they had out there in their tax return. We hold it for 3 months. We hold it for 6 months. We hold it for 12 months. We have no guarantee that these young men are actually holding for that length of time. They could be doing a ton of short-term trading, which is really not a very good idea either. Short-term trading tends to work poorly too. So it's possible that they are getting better returns through reduced risk. Also possible they are not actually getting better returns at all. We're just assuming they buy and hold for 3 months before they reposition their portfolios. All right, so just to wrap up our paper here, because that's the main results they have. They have some additional sort of robustness tests that I'm not going to cover. They have a randomly assigned group here through the Taiwan military draft. That is probably the key selling point for this paper, that they have randomly assigned social networks. Now, they can't observe it directly, but they do some clever things to estimate it. I don't really have issues there. Their description of how they're estimating that this person is a member of the military, since pretty much everyone gets drafted, they're pretty safe in that the person's going to be there. The problem is that they're going to have, I think, is everywhere else. So they do find more stock market participation. They find that they buy the same sort of stocks as their peers. Not a huge issue there. When they try to disentangle their information versus peer pressure, I'm just not convinced that most of these variables are really capturing information sharing versus peer pressure from social status of the peer. I'm especially skeptical that their financial literacy measure is correct, not because I think people with finance degrees have high social status. We tend to not, actually. But you're including management with finance and economics and saying this is about financial literacy. I just don't believe management majors are going to have similar levels of financial literacy to a finance or economics major. I mean, the management major might have more literacy than someone without a college degree at all, or someone who majored in something completely unrelated to financial knowledge, like music or something. But I would remove management and put in accounting. Like, why are you putting management with these two? That really bugs me, which is why I'm talking about it multiple times now. So I feel, because anyone who's going to review this paper is going to be a college professor who teaches classes, and a lot of us are going to have taught management majors in an intro class, and we know like the management majors are not the same as the finance majors, and they don't take the same classes, and I feel like that's a real problem for them when they try to get this published somewhere. Now, they possibly see improved returns, but there's a lot of weak results here. And the portfolio, there's issues of we don't really know if they're actually buying and holding, because we can only see what they buy, what they have every year. So the higher returns, it's surprising they find any evidence at all for higher returns, but I'm not like it's not that strong. And we don't really know if they're actually getting better returns. And another issue they're going to have, which is something that the discussant, when they presented their paper, mentioned, is there's not that many of these people owning shares of stock, despite this peer effect. So they find an average of basically 8% of their total population per year owns stocks. That's not very high. Now, it's a pretty normal looking number just based on how many 22-year-old men own stocks. But the vast majority of people here are not participating despite the peer effects. Now, if we truly believe the randomly assigned groups are perfectly done here, we are maybe fine. It was randomly assigned, so even though it's a low stock ownership, we are protected from any concerns about our sample not being okay. But if there's any doubt at all about the randomly assigned groups, this really hurts them, because it could be that there's just some weird people in this group of young men, and everything is being driven by these guys, and we wouldn't actually see an increase in stock market participation if we had a different group of people experiencing a social network. So yeah, it's a working paper. I think there's some potential problems with how they're doing things. The results are in some cases are problematic. So I suspect they're going to have to make some changes there, or if maybe they just get lucky and the referee doesn't really hammer them on this. But I really think their measure of financial literacy is not, doesn't make a lot of sense. And also, I mentioned this before, but they split things into high versus low and into subsamples, and they're really bad about telling you even how they did it as well as the theoretical reasons behind it. Now, this is a problem in many papers that I will probably be highlighting, but it's particularly noticeable here because for some of these samples, I have no idea how they're splitting by income or age. Are you splitting at the median? Are you splitting into terciles? You don't seem to be telling me, not even just telling me what you do, let alone giving a good theoretical reason why you should pick that split versus other ones. Anyways, so that is all our paper for today. And next week we'll probably continue with another paper from the AFA. There's quite a few interesting ones, and there's still a couple more I want to go over. I'll see you all next week.